In this video, we will share 3 ways to use the moving average indicator to generate accurate trade signals. If you are serious about trading, you should definitely check out our free training program. The links are in the description below. With that being said, let's get into today's video. What is a moving average? A moving average is a simple technical indicator that calculates the average closing price of an asset over a particular period of time. So, a 10-period moving average calculates the average close price of the last 10 candles. A moving average helps us reduce the noise of the markets and paint a clear picture of a trend. Different moving averages are used for different trends. A 200-period moving average can be used to identify the long-term trend of the market. Similarly, a 20-period moving average can be used to determine the short-term trend of the markets. 2050, 100, and 200 are some of the most popular moving averages. Generally speaking, a moving average is used to identify the trend of markets and simplify the price action. But let's dive deep into the specific uses of the moving average that can help us make better trade decisions. Uses of a moving average. The moving average primarily has 3 uses. Number 1, identify the trend. Number 2, identify a trend change. Number 3, identify areas of support and resistance. Let's start with identifying the trend using the moving average. The moving average is a trend indicator. Therefore, its primary function is to help us identify the trend of the price. Now, we have 3 techniques to accomplish that. Price versus moving average. The location of the price compared to the moving average can help us determine the trend of the markets. If the price is currently above the moving average and has consistently stayed above it, then the price is considered to be in an uptrend. As a logical trader, we want to trade in the direction of the trend. Therefore, we should be looking out for buy opportunities in this scenario. On the other hand, if the price is below the moving average and has stayed below it for some time, then the price can be considered to be in a downtrend. We should look for selling opportunities in this case. Lastly, in sideways or range-bound markets, you'll see that the price does not stay above or below the moving average for longer periods. It always switches above and below the MA like a pendulum. In such scenarios, it is best to stay away and wait for a clear trend to develop. A simple trick for a better analysis would be to use the 2 moving averages with different period settings. This way, you get the long-term and short-term analysis of the price. Here is a simple example. On this chart, we have 2 moving averages. The yellow line is a 20-period average, and the blue line is a 200-period average. The 20-period average is a short-term moving average, so it should give us the short-term trend of the 200 MA is a long-term moving average. The 200 MA gives us the long-term moving average of the market. Therefore, it gives us the long-term trend of the market. The 200 MA for a moment. Now, let's completely If we only focus on the 200 MA for a moment, we can say that during these periods, the price was above the moving average, which indicates that the price is in an uptrend. Above the moving average, which indicates that the price is in an uptrend. Similarly, during these periods, the price was below the moving average. During these periods, which indicates the price was below was in a downtrend. Therefore, which indicates we should look for selling in a downtrend. Therefore, but if we look closely for selling, not a lot of price movement. But if we look in these down moves, there was not a lot of price movement. Now, if we add the 200 MA back, we can see that the price stayed above the 200 MA back. We can see that the price stayed above. This indicates the 200 MA was in a long-term uptrend for the whole time. that the price was in a long-term uptrend, we can say that selling during this period would have been risky because we would have been trading against the long-term would have been risky because we would have been trading another example against the long-term when we zoom into this section of the chart. Here is another example. We see that the price was moving around into this section of the chart for an extended period of time. We see that the price was moving around the 20 MA. It means that for an extended period of short-term sideways trend. Therefore, but at the same time, the price is in a short-term sideways trend. The 200 MA. But at the same time, this means the price stayed above the long-term 200 MA. So we have a sideways that the price is in a long-term upward bias. So we have a sideways trend. Either we avoid trading upward bias because of the sideways movement. Either we avoid buy trades because around the lower end of the range, or we can place buy trades around the lower end of the range. But we cannot enter sell against the long-term at the upper end of the range using because that would go against averages the long-term will not provide you with better trades. Using two but it will help you avoid bad trades. Will not provide you with if better you are trades. Enjoying the video but so it will far, help you avoid then like bad this trades. Video and if you are enjoying to our channels so that you never miss then our like new videos. This video and subscribe to our channels that you never miss our moving average also gives us a good hint about the strength of the trend. The slope of the moving average also gives us a good hint about the strength of the trend. In a strong uptrend, the moving average of the moving average will be in a strong uptrend to a 45-degree of the moving average, while in a weak uptrend and close we see a gentle upward slope. While in a weak the same thing applies to downtrend. We see a gentle upward in a strong downtrend. The same thing applies to downward slope. In a strong downtrend, 45-degree angle. We see a steep downward slope. In a weak downtrend, with approximately we have a gentle downward slope. This information is helpful. We have a gentle downward slope. We can be more aggressive in our entry because if the trends are strong, trend is weak, we can be more aggressive in our entry with our trades. But if the trend is large versus small, we must be more careful with our trades. Another way to identify the trend of the market moving average is by using two. Another way to identify the trend of the market looking at their is by using two. For example, averages. We have plotted looking a 50 at their position and 200 MA. For example, on the chart, we have plotted a 50. The 50 and 200 MA is called on the smaller MA. And the 200 MA is the larger MA. The smaller MA. When the smaller MA is above the larger MA. The price when the smaller MA is above the larger MA. And in an uptrend, the price is considered to be an uptrend. On the other hand, uptrend, when the smaller MA is below the larger MA. On the other hand, we consider the when the smaller MA is below the larger MA. And as logical traders, the price we need to look for selling opportunities. And as logical traders, we need to look for selling opportunities that can be used to identify the trend. So these were the three techniques that can be used to identify the trend. Now, using the let's learn how to use the moving average to identify reversals. Let's learn how to identify the moving average to identify reversals. We have two techniques to identify a trend reversal. Price crossover. We have two techniques. As we discussed earlier, the price tends to remain above the moving average. As we discussed in an uptrend. And in a downtrend, to remain above the moving average. Below in an uptrend, the moving average. And in a downtrend, using the same price logic, remains below when the price crosses the moving average. Using from above, the same logic, it indicates when the price crosses the moving average and a downtrend will begin. It indicates that the uptrend is over. It indicates and a downtrend reversal will begin price. Therefore, similarly, it indicates when the price crosses above the moving average from below. Similarly, it indicates when the price that the downtrend above the moving average from below, and the price will start a new uptrend. That the downtrend remember, not all crossovers are new uptrend, and many of them can be fake signals. Not all crossovers to avoid such false signals, and many of them can be fake signals. We can use a moving average crossover to avoid such false signals. A moving average crossover is one of the most popular ways to use the indicator. Crossover for this is one of the most popular ways to use the indicator. Two different periods for this. We need just like moving averages. We'll use two different periods and 200 MA. Just like for this as we'll use the 50 earlier. And 200 we learned MA that in an uptrend as well. The smaller MA earlier is above the larger that MA. In an uptrend. Similarly, the smaller MA in a downtrend is above the larger. The smaller MA is below the larger. In a downtrend. The smaller MA is below. We can say that whenever the smaller MA using crosses the same below logic, the larger we can MA, say that whenever the smaller MA crosses below from the larger MA to a
it
downtrend.
indicates that the price
So
has shifted
it is a sign
from
of
an
an bearish
uptrend
reversal
to a downtrend.
Similarly,
So
when the
it is a
smaller
sign of
MA
a bearish
crosses above the
reversal.
larger MA.
Similarly,
it indicates
when the
that
smaller
the price
MA
has shifted
crosses
from a
above the
downtrend
larger MA
to an uptrend.
it indicates that the
Hence,
price has
it is a
shifted
sign
from a
of a bullish
downtrend
reversal
to an uptrend.
We do not suggest
Hence,
you
it
place
is a
trade
sign
at these
of a bullish
reversals,
reversal.
but you see the
We do
begins.
not suggest you place trade at these reversals, but you see the begins.